In one day this week, more than 350,000 traders were wiped out across crypto. $1.75 billion gone in 24 hours. That is what high leverage does when the market turns. And right now, the most powerful names in finance are fighting Washington for the right to sell that same kind of leverage to you. The company that owns the New York Stock Exchange wants in, so do Coinbase and Kraken. The product they are all chasing has been off-limits to American traders for a decade, and the man who runs the biggest futures market on Earth calls the whole idea, in his words, a disaster waiting to happen. The puzzle is why the most cautious firms in the world are sprinting toward a contract that can empty an account in an afternoon. The answer starts with one man and one sentence. That man is Jeffrey Sprecher, who runs Intercontinental Exchange. At a Bernstein conference on May 27th, in remarks reported June 8th, he said his company has been talking to regulators about launching perpetual futures. His line was blunt. What we are saying to regulators is, can we do that? Why are you prohibiting us when it's already happening? And he isn't alone. Last month, the Commodity Futures Trading Commission, the US regulator for futures, started opening the door to crypto perpetual futures. Per CoinDesk, that move triggered a race among exchanges, Coinbase and Kraken named directly, to capture a market that is the majority of global crypto trading. The part most coverage skips. These contracts have historically been banned for American traders. So, what is this product, and why was it forbidden for so long? A perpetual future is a bet on a price that never expires. That's the whole trick, and it's why these things are so dangerous. A normal futures contract has an end date. You agree today to settle next month, and next month it's over. A perpetual has no end date, so you hold the position as long as you like, never forced out by the calendar. That creates a problem. If a contract never expires, what stops its price from drifting away from the real asset? The fix is the funding rate, a small payment that traders on the crowded side of the bet pay to the other side over and over. It's the leash that pulls the price back towards spot, the real current price, and keeps a no-expiry contract tied to reality. The second feature is leverage, a lot of it. In the new contracts, it runs up to 50 times. That's the figure cited in trade coverage of these terms, and it's why a 2% move the wrong way can wipe you out. The pre-IPO versions, contracts on a company before it goes public, go further. Per the street, the holder owns no shares, no vote, no claim, just a wager on the valuation. No expiry, high leverage, a pure price bet, and every player in this story is racing to sell it. This product has been around for a decade. It just spent that decade offshore by design. A crypto exchange called BitMEX, co-founded by Arthur Hayes, invented the modern perpetual swap back in 2016, and that funding rate mechanism from the last chapter was the clever part they built. Why did it never come on shore? Because the US equivalent of a perp is a swap, and the swap rules under Title VII of the Dodd-Frank Act, the law written after the 2008 crisis, made this exact product legally radioactive here. It lived overseas instead. And the wall was enforced. In November 2023, the CFTC settled with Binance for $2.85 billion over selling unregistered crypto derivatives to Americans. That was the wall. This week, it started coming down. To see why Wall Street suddenly wants in, look at the company that scared it. It's called Hyperliquid, a blockchain-based exchange where people trade perpetual futures on crypto and on commodities and private stocks too. Per Fortune's framing, it was built by a Harvard grad with around 11 people and no venture funding, and it won. Per CoinDesk, it's the dominant player in decentralized perpetual futures, accounting for the majority of on-chain derivatives volume. It also makes real money, which is what made TradFi pay attention. Per CoinDesk, citing DeFi Llama as of early June, it's running over $1 billion a year in fees, up from almost nothing. Then came the moment the old guard couldn't ignore. Per the ICE interview, Hyperliquid broke into the mainstream with 24/7 oil markets during the conflict with Iran, letting traders bet on the price of oil around the clock. Sprecher rejected reporting that ICE is pressing regulators to rein Hyperliquid in. He says ICE is talking with the team and learning from them. He put it plainly, "I love these guys. I wish I was younger and doing it. You do not admire a thing you are trying to crush." ICE wants to run this market itself, at Wall Street scale. That is the land grab. Here's the move worth understanding. The offshore venue, the one run from outside the US, beyond these rules, becomes a side door for US clients, and the regulator holds it open on purpose. Two different things are happening, and the headlines blur them. First, the offshore wave, for non-US traders only. On June 3rd, Coinbase launched a pre-IPO perpetual on SpaceX through Coinbase Bermuda, and per Crypto Potato, it's not available to US citizens. On June 7th, Kraken did the same at up to 5 times leverage, and per Traders Magazine, its contract is barred in the US, the EEA, Canada, Australia, and New Zealand. Second, separately, the regulated onshore first. On May 29th, the CFTC issued a no-action letter. That is the lightest kind of permission there is. Staff-level relief the regulator can withdraw as fast as it granted it. And per the ICE article, that same day it approved the prediction market Kalshi's listing of a Bitcoin perpetual. 5 days later, on June 3rd, Kalshi's contract, ticker BTCPERP, went live. Per Crypto Briefing, that makes Kalshi the first US exchange to offer crypto perpetual futures to US investors, with 0 fees at launch. And here's the side door. That same May 29th letter also lets US customers reach contracts on Coinbase Bermuda, treated as foreign futures under US law. The offshore venue becomes a legal route in for US clients, with the regulator's blessing. The CFTC's new chairman, Mike Selig, said the agency would use the tools at its disposal to onshore crypto asset perpetuals. The most forbidden product in US finance just got its first regulated foothold, and nobody wants to be last. Not everyone thinks this is progress, and the loudest skeptic has the most to lose. Terry Duffy runs CME Group, the world's largest regulated futures exchange. At Piper Sandler's conference on June 4th, he called perpetual futures a disaster waiting to happen. He told Bloomberg he is very concerned. His worry is concrete. Per Bloomberg, Duffy says perps offer little practical use for institutions while handing retail traders access to excessive risk. Per Cryptopolitan, he warned that extreme leverage plus automatic liquidation threatens retail traders, who may not grasp how funding rate costs eat their positions. You can be right on direction and still bleed out paying the funding leash. And the same week he said it, the danger showed up on the tape. In a single 24-hour window, per Yahoo Finance, 351,233 traders were liquidated across crypto, wiping out $1.75 billion, following Bitcoin's drop to $59,100 on June 5th, its lowest of 2026. That is the kill switch in action, the exact machine Duffy is warning about. No reporting has tied that particular cascade to the new contracts. What it shows is the mechanism he describes, high leverage meeting automatic liquidation, running through the market in the same week he sounded the alarm. Duffy is the loudest skeptic, and he is outnumbered. Sprecher at IC admires Hyperliquid and wants in. The CFTC wants these products onshore where it can watch them. Even Arthur Hayes, who helped invent the perp, treats the danger as competitive, a threat to Hyperliquid's market share more than a threat to traders. 3 of the 4 big players want this market in the open. Duffy is the one calling it a loaded gun aimed at retail. Here are the dials worth watching from here. The first is the rule itself. That US opening is still just the no-action letter, so watch whether it hardens from staff relief into an actual rule or gets pulled. Sprecher says regulators in the coming months have to decide whether to build a new category for regulated perpetuals or force venues like Hyperliquid under the old Dodd-Frank swap rules. And watch whether the incumbents move from talking to trading. ICE has not launched, and per CoinDesk, Kraken is expected to launch a US product later this month. The second is Hyperliquid itself. Per CoinDesk, analysts note its buyback model leans on sustained trading volume and could come under pressure if derivatives volume falls. As Wall Street crowds in, watch whether it holds its ground. And the last is the live test case. SpaceX is expected to go public this week, around June 11th or 12th. The sources disagree on the day. Sprecher flagged it himself. Watch whether this private market's price moves the IPO. There's one precedent. On the chipmaker Cerebras, the perp pointed near $320 and the stock opened near $350, far above the $185 the bankers set. If that repeats this week, it would be one mark in favor of the price discovery case. One data point, not proof. Strip away the friendly headline about Wall Street adopting crypto, and here is what is left. The most cautious firms in finance are racing to copy the most dangerous product crypto ever built. Its biggest critic calls it a disaster waiting to happen, and the regulator is holding the door open anyway.